Welcome back. Well, some good news for your wallet, hopefully, now that the Federal Reserve has cut benchmark interest rates for the first time in 9 months. We're getting an idea of what this is going to do for the everyday consumer. Keep in mind, since the last cut, progress has been made on inflation, which has slowed while the labor market has cooled. We want to bring in right now Dr. Abigail Hall, an associate professor of economics with the University of Tampa. She's going to break down the nuts and bolts of this for us a little bit. Hey, Dr. Hall.
Hi, great to be here.
Good to have you with us. Let's talk kind of generally first. I know this is going to show up in a lot of different ways for a lot of folks, but what's the most obvious way this is going to impact most people?
So for most people, you're probably most likely to see this cut in interest rates in terms of what you're paying on your credit cards. So when it comes to this Fed rate, what we call the benchmark rate is what sets the prime rate, and the prime rate is what most credit card companies use to determine interest rates. So for most folks, that's probably the place that they're going to notice it most clearly if they carry debt on their credit cards.
Now, when we talk about the housing market, we definitely have seen that cool off a little bit, right? Will this increase and really help people when they're trying to get a loan to buy a home or a mortgage to get a home or something or in that area?
So the short answer is that this likely is not going to have a big impact on mortgage rates, at least not this single cut. So we're looking at projections of mortgage rates on average between 6.3 to 6.4% by the end of the year. So if people are hoping that this rate cut is going to be bringing those rates back under, say, 6%, I would not recommend holding your breath waiting for that to happen. Now, the one exception is that if somebody has an adjustable rate mortgage or an ARM, this may lead to a decrease in their interest payments. But again, this is going to probably not impact most lenders or most borrowers, especially if you already have a loan.
And if the Fed, as they've indicated, could go as far as 2 more cuts by the end of the year and another cut next year, will we see a stronger impact, for example, on mortgage rates at that point?
It's possible. So it's not always the case that interest rates on mortgages follow exactly what the Federal Reserve is doing. But if we do continue to see successive cuts, as you mentioned, this may very well put some more downward pressure on those mortgage rates. But again, not anything like what we were probably seeing, say, 5 or 6 years ago.
Any action that folks could be doing now that this has started to trend downward a little bit, or just leave it as is and kind of just enjoy whatever benefits you might see from it?
So in this case, this is not really a significant enough of a drop for most people to probably notice in terms of, again, car loans or home loans or things like that. If people are interested or they're in the market for a home or they're in the market for a car, one of the things that people can do is to try to take control of those variables that are frankly under our control. So things like paying bills on time, having equity in your home, trying to build up equity, things like that. And to the extent that people do see a reduction in things like the interest payment on credit cards, seeing if you can pay off those kinds of debts.
All right, Dr. Hall with the University of Tampa, we appreciate you so much for joining us today. Always good talking with you.
Pleasure.